Welcome back to ChainFinance. Today, we're breaking down one of the most powerful smart money concepts, a concept professionals use daily, a concept retail traders often ignore. We're talking about fair value gaps, also known as FVGs, and their role in market imbalance. Understanding this changes how you see price. Let's start with the basics. Every candle represents an auction of buyers and sellers. When both sides are balanced, price moves smoothly. But sometimes, the market moves too fast. Buyers overpower sellers, or sellers overpower buyers. This creates a gap in price efficiency. That gap is what we call an imbalance. And inside that imbalance, you find your fair value gap. An FVG occurs when one of the three candles doesn't overlap the other. In a bullish move, the middle candle pushes so hard upward that it leaves a gap between its low and the previous candle's high. This gap shows missing price action, meaning price did not trade fairly there. Institutions don't like imbalance. Markets aim to fill these inefficiencies. So when an FVG forms, price often returns to rebalance. This creates powerful trading opportunities, because rebalancing gives precision entries and shows where the market may revisit before continuing. Now let's break down bullish FVGs. When price shoots upward aggressively, it leaves a gap in the middle. Price later returns to that gap. Sellers take profit. Buyers re-enter, and the trend continues upward. This is a bullish FVG fill. It acts like a discount zone for continuation trades. Now let's look at bearish FVGs. When price drops extremely fast, it leaves a downward imbalance. Price will often retrace back up into the gap. Sellers reload. Buyers exit, and price continues downward. This is a bearish FVG fill. It acts like a premium zone for selling continuation. FVGs are not random. They appear in aggressive institutional moves. They signal displacement. Displacement shows strong imbalance of power. Understanding displacement plus FVGs gives clarity. You see which side controls the market, and where price is likely to return. FVGs also align with liquidity. Liquidity lies above highs and below lows. When price sweeps liquidity, it often creates imbalance immediately after. This imbalance tells you the real direction. After the sweep, price moves strongly, creates an FVG, then pulls back into it before continuing. This gives a high probability entry. Professionals wait for these pullbacks. Retail traders chase candles. FVGs teach patience. They show where price is fair and where price is unfair. Markets always seek fairness, and that's why imbalances get filled. But not every FVG fills immediately. Some fill hours later, some fill days later, and some never fill at all. This is why context matters. Always analyze structure. Always check the trend. Always confirm displacement. FVGs inside strong trends get filled quickly. FVGs in weak trends may take longer. Use multiple timeframes for clarity. Higher timeframe FVGs are stronger. Lower timeframe FVGs give precise entries. Combine both for the best results. Liquidity gives displacement, gives FVG, gives continuation. This is the formula professionals use. Trading becomes structured, not emotional. You stop guessing, you start anticipating. You see where institutions left footprints, and where price must return to rebalance. This is the true power of FVGs, not signals, not patterns, but inefficiency correction. Something the market always respects. Study them every day. Mark them on your charts. Watch how price reacts around them. Over time, you'll see the logic, and trade like someone who understands the deeper mechanics of the market.